Good afternoon, everyone. Welcome back to my show called Tax Bites with Poonam. Today, I'm back with one of my good friends in the studio, and I am pleased to introduce Rebel Smith Quillin. She is a friend of mine who is also a CPA, and she's transitioning into retirement from Brownsville, Texas. She began her accounting career in Austin while attending the University of Texas. She had the unique opportunity to work with the state CPA firm in her senior year of high school. She continued working there for the next 10 years throughout college. After that, I think she started her own firm, and she married her husband, David, and they moved from Texas to Minnesota. So they stayed in Minnesota for almost 2 years, while, again, I think they moved back to Austin, Texas, and that's where her practice began to flourish. I met Rebel personally last year, and we had an instant connection. She and I have the same ideologies and philosophies as to handling the clients and how we handle them personally and professionally, and how we tackle the tax and the accounting portion of it. And it's our hope to collaborate in the future with each other in regards to the tax issues that impact the clients. So, ladies and gentlemen, let me introduce and bring on Rebel Smith Quillin. Hey, Rebel, how are you?
Hi, I'm doing well, thank you.
Thank you for coming to my show.
Oh.
And so how are you doing today?
I'm doing well. I drove in from Brownwood today, and that's about a 3-hour drive, but
Yes.
It was a pleasant drive today. So
It was, right.
It's good.
And the weather is nice.
The weather is beautiful today.
Yes. So tell me something. I mean, I know you started off, you worked in one firm, and then all of a sudden, after 10 years, you wanted to go your own. So what motivated you to start your own practice?
Well, in actuality, sort of what happened is I was working for a firm. It ended up, I worked for 15 years, and my husband proposed to me. So at the time, he was just the boyfriend.
Okay.
He was moving up to Minnesota, and he had decided he was not going to move up there by himself. So he proposed. And at that juncture, it was, okay, I've got to decide, am I going to just continue working for somebody else or try to start my own practice?
Right.
And so we moved up there, and I did go to work for a small firm briefly, and it was just not really working out the way I anticipated. And then I started doing some contract work for a local CPA there, as well as still doing some contract work in Austin. And things just evolved after that, and just it was great. And then David got an opportunity to move back to Austin. I said that would be great because I have a lot of contacts there.
Right.
And I really felt like my practice would take off once we moved back. And that's exactly what happened.
It did. Right. So what do you think is the right balance, in our careers, in our CPA profession? What do you think is the right balance? Because mostly the clients are saying, okay, you want to do the tax preparation, but at the same time, there's a tax planning strategies that needs to be, come into so that we can keep a right balance. So what do you think in your career, the long 30 years career, what do you think was the right balance? What made you?
Well, there's a lot of things that kind of go hand in hand. The tax preparation actually ends up leading into planning oftentimes, because as you're preparing the return, you see things that you go, maybe we need to talk about this after tax season. During the tax season period, which, usually starts February 15th all the way to April 15th.
Correct.
You're not thinking about planning for the client. You're just really trying to get through the return.
Correct.
And most of the time, whatever has transpired for that tax year that you're working on, it's too late. And so, but while you're working on the return, I find it helpful to make notes and try to keep a diary, so to speak, of, this client, they're getting near retirement. What things should we be talking about to help begin to plan their tax strategy, if you will,
right,
into retirement? Or they've just had children.
Right.
And should we consider 529 plans or not? You know, there's some philosophies that, you know, some people say, no, let's not do them. And then the 529s, there's those that say, yes, we love them. I'm kind of on the fence. I've seen them be good for some clients. I've seen them not so good for other clients.
Correct.
And so I really feel like it's hand in hand. And I do, over the course of my career, I have noticed that the planning has become more important than the preparation. I think clients, you know, that are very simplified can do their returns if they so desire.
Right.
But there's nothing that's going to take the place of good strategic tax planning,
Right.
even if you do your own return.
Right. Right. And I agree, because when we are preparing the return, we find stuff out and then we kind of write it down and we come back and circle back during that year for the next season so that we can do something, you know, in October, November, and December. That's when I think our planning hits to see what we can do better next year,
Right.
if there is anything that can be changed.
I agree.
Makes sense. And sometimes the client is a new, so they come in and it's too late to do anything. So obviously that shifts to the next year automatically. Okay, so what about the retention, the client retention ratio? Because not only in our CPA profession, everywhere else, what do you think is one thing that made you hold on to clients for so long, as I have seen?
Right.
You know, that there are clients who are working with you for the last so many years and they still love you.
Yeah. Yeah, I've been fortunate that I would say most of my clients have been with me 30 plus years. And I do think a vast majority of the reason for that is I've made connections with them in a relationship way.
Right.
It's not just about the work. For me, the relationship is more important than the taxes or the money.
Right.
I want to know my client.
Right.
And it's kind of, I guess from my religious background, it's how would God want me to treat somebody else?
Right.
And how would God treat this particular client in this situation that we're in? And make a connection. Everything's relationship.
Right.
If you don't have the relationship, it's really nothing.
I agree. That's true.
And so combined with that and then being punctual,
Getting back to them on
getting back to them, I probably respond sometimes too quickly because I like a clean inbox. And so I've had to train myself with my email, especially during tax season, to shut it down.
Because it's hard.
It's hard. You see the email come in and you want to respond immediately to let them know that you're there and on top of it.
Right.
But if you keep doing that, you don't get any work done.
You don't get any work done, especially during tax season.
Right.
That's true. And that's what I'm facing too. I face most of the time. But we try.
Yeah.
I think we try to. And I think responding to emails is good early in the morning or sometimes later at night.
Right.
When you're not. Yes.
And I've discussed with you that I have odd work hours.
Yes.
I find that getting up at 3:30 in the morning
Works better for you.
works the best for me because the phone's not ringing, the emails are not popping out, and I can get a lot done. And then when the daylight hits and clients
ready.
are, reaching out to me, I can respond.
Right. Was that always like that when the kids were younger too? Or
It
no?
probably happened because the
Because
kids
of the
were
kids.
younger.
Right.
And so I wanted to try to spend some time with them, even during tax season. And so I would go to bed when the kids went to bed.
Right. So you kind of started early on and then you be with them in the evening when they come through.
And now my body's kind of used to that cycle and I'm trying to break it and I've not been successful yet.
But it's a good habit, early to bed and early to rise.
There you go.
That's great, actually. So what do you think about the accounting profession now that the artificial intelligence and all that we are seeing that, they're going to take over and, the CPAs are not going to be in demand anymore. So what's your take on that?
I think that, artificial intelligence is going to do some of the work for some people.
Right.
But AI is never going to take the place, I don't believe, of actual thinking through a problem and trying to devise a plan that's different than the black and white, if you will. There are yes and no answers, absolutely, within the tax code. But there is a lot of gray. And I just don't believe AI is going to be able to differentiate between a gray area.
That's true.
Maybe later on when I'm buried, right. But not right now.
And I always think, like, even if that takes over, whom are they going to blame on? Like, like if they're auditing or something.
Right. Yeah.
Like, autopilot. Okay, they're pilots still. That's an autopilot, but there's a pilot still who's, whom they have to blame.
Right.
If something goes wrong. So I guess human touch is necessary.
I think human touch is necessary.
I agree.
I know that there are phone calls that come in that are definitely AI, and you can tell immediately.
Right.
Most of the time you can tell immediately.
Right.
And I think that's going to be the same even with tax preparation and auditing.
Yes.
There's a degree of judgment
That's
that
required.
I don't think AI has.
I agree. That's true. Okay, well, thank you so much.
You're very welcome.
It was great talking to you, and thank you for answering all my questions. And it was great having you on my show. Thank you. Okay, so it was great interviewing Rebel. And now in the next segment, Rebel and I are going to talk about some of the tax planning strategies that you all can see, maybe try to plan ahead in 2024. And she and I will go over some of the points. So you ready, Rebel?
I'm definitely ready.
Okay. All right, good. So tell me something. Let's start with maybe some of the elderly people. You and I both have clients like that who are, transitioning into retirement or maybe already have. So what do you suggest? What do you suggest to them about the traditional IRAs and the Roth IRAs?
One of the things that I'm exploring with many of my clients that I have, and this even started this past year, was trying to figure out their 401ks and their traditional IRAs that they have now. Many of them are getting into what we call the required minimum distribution rules. And we're finding that when they're having to take these minimum distributions, it's causing a tremendous tax impact on them. And it's making an impact on many of them with their Medicare insurance premiums. Because as your adjusted gross income gets larger, Social Security / Medicare Administration gets a hold of that and says, we have to charge you an extra amount over the base rate. And so now we're beginning to strategize and go, well, should we convert some of these 401ks or traditional IRAs into Roth IRAs? And that way we get, unfortunately, it's a chunk of change that's going to have taxes impact immediately, but maybe we can get it out so that as they begin to take them later, they have a lower tax bracket at that point. Because one of the things that we're having to look at too is 2024 and 2025 are the last 2 years that we have with the lower tax rates that we have.
Correct.
And so 2026, we're going to start bumping up again.
Yes.
And if we can do some strategizing and keep some of this conversion in a lower tax rate, that's going to help later on. I've got a tax rate comparison, if you will. I mean, right now in 2023, we go from a 10% tax bracket to a 12% tax bracket, then a 22, and then they go on from there.
Right.
2017 is what we're going to sunset back to. That's what we're going to fall back into. We've got a 10%, and then it goes to 15. Yes, so there's a 3% jump there, and then 15 to 25. And so it would be great if we can start getting taxpayers to think about, well, how much room do I have in the 22% tax bracket in 2024's tax return before I go over to 24%? And can I convert some of that IRA into that lower tax rate?
Definitely.
And so then you have to find out from the client, what can they stomach, if you will?
Right.
What tax rate can they tolerate?
Right.
Going from a 22 to a 24 is only a 2% difference.
Right.
So maybe we squeeze it into the 24% tax rate as opposed to just bottoming out or topping out, I guess, at the 22. And so those are some of the things that this summer, with clients that have significant 401ks or IRAs, that it would be suggested that they start looking at that, because we have 2 years in order to get some of that done. And then, of course, there is a philosophy of just rip the Band-Aid off.
Right.
Convert it all, bite the bullet. But, to do that, you have to have funds to be able to pay the taxes. So
True.
I'm more of, let's see what we can afford. And see if we can convert those at that point. And, kind of coupled too with the tax rate changes going back is the standard deduction is going to be reduced as well. It's going to go back.
It's going to go back to the 2017.
People that have been now using basically $27,000, almost $30,000 as their standard. They're going to go to 15 if they're not itemizing. So there's another automatic tax increase without even considering the brackets that are increasing.
Right. Perfect point. Yeah, that's excellent. Excellent explanation. That's true. Yeah. And then maybe, lingering on to that concept of Roth IRA, how we kind of tell the clients, if they have even younger kids, if they have an earned income, maybe start them early.
Absolutely.
Then they can have them on an earned income and get the Roth IRA started for them.
Right.
Okay. So I guess some of the business clients of mine would say that I have a 7-year-old or an 8-year-old. I think if they are helping them out in their business, do you think, I personally think that they can have an earned income?
At 8 years old, if you've got them emptying out the garbage and sweeping and doing some tasks, but, you have to be sure to pay them commensurate with what the responsibility is.
Correct.
And so if they're doing those kinds of tasks, you can't say, I'm going to pay them $6,000,
Right.
But, certainly within reason.
Within the reasonable amount. And that total can go into the Roth IRA as an earned income.
Yes.
And they have age.
Yes.
That's
and
the perfect
that
point.
gets that 5-year clock ticking for them
Early on.
One of the strategies, if a parent can do it, that I encourage, so that it encourages the child to save, is perhaps match a portion of what the kid puts into the Roth. So they're not having to put the whole amount in themselves.
Right.
But they see that if I put in $1, mom and dad might put 50 cents in.
Right.
So.
Right. Yeah, that's perfect. That's perfect. Now, coming down to the kids again, let's continue with the college planning. So when they get older, so, the 529 plan. So I know we've discussed it before and, how we feel about it. But then how about the new rule that has come in about the leftover 529 plans going into the Roth IRA?
Yes.
Right? So, but there are restrictions.
Yes, there are very many restrictions on that.
Yes. So let's talk about that. So what I researched was that they have to be open for more than 15 years, right? And then let's talk about how some people just put the money in and then the next day they can do the rollover. Is that true?
No, it's not true. It'd be too easy.
It'd be too easy. So you have to have the holding period for 15 years. And then before the rollover, the money has to be in for at least 5.
That's correct. 5 years.
Right. So now, what about the Roth IRA? correct me if I'm wrong, but I'm thinking that they have to have that kind of an income. So, for example, the Roth limit is 6,500 if you're younger than 50. So they have to have that kind of an income to roll it over.
The person that's doing the rollover still has to have earned income and able to make that work. That is correct.
Correct. So it's a good thing for a 5 to 9 plans, because I think they were declining and we were going more into the college planning or, something like that. But I guess if the kid decides not to go to college,
and
right?
that's what was happening, is so many kids were not going to college that the parents were ending up with significant money left in the 529s and no beneficiary that they felt like they could pass it on to.
Yes. So this is excellent for them, I guess.
And honestly, that was one of the things that was not my favorite thing about the 529 is what happens if the kid
doesn't decide
they don't
against
go,
it.
You don't have a grandkid to give it to.
Right.
What happens?
What happens with the money?
Yeah.
So is there a limit of that? How much total? Do you think it's about $35,000?
I believe it's $35,000.
So not more than that can be rolled over to the Roth.
And that rule, this particular planning opportunity starts in 2024.
Right.
And I believe there may be some rules that are still going to be rolling out in regards to it.
We hope so. And we'll have more information.
Yes.
Yes. Good. And then what about, remember you and I were talking about the charitable contributions?
Yes.
So you want to touch on that? I think that was an excellent point.
Right.
Yeah.
Primarily during these years that we have had such high standard deductions, like I said, almost $30,000 for the 2023 year, I believe, for a married couple.
Right.
It's $27,700. And so many taxpayers were finding that they were no longer getting any benefit from their charitable contributions.
Yes.
So clients would end up, say, contributing, $15,000. Their property tax was getting capped at $10,000.
Right.
So now they're at $25,000. And then if they had their mortgage, and they had a low interest rate back in the day, and they had $5,000. I mean, that was the standard.
Correct.
And so one of the things that has been very beneficial is saying, let's do what I call bunching. And bunching used to be done a whole lot of times with bunching your itemized deductions every other year. So if you're able to afford it, you, instead of putting $15,000 towards charity, you would put $30,000 towards charity in 1 year. And the mechanism you would do this with is what we call a donor advised fund.
Right.
So you could put cash in it. So you could put $30,000 of cash in 2024, pay out $15,000 in 2024 out of that donor advised fund. And then in 2025, you have the remainder that you can pay out. But you're getting the $30,000 charitable deduction in 2024. So instead of just being at standard, now you've got $15,000 that's getting deducted in some tax benefit.
Right.
And then coupled with that, a lot of people will have what we call appreciated stock.
Right.
And so let's say you've got some Apple stock that you bought back in 1980, and it's going to cost you an arm and a leg to sell this stock because of the taxes. Donate it to the donor advised fund. You get the fair market value of that stock as a deduction, and you don't pay the tax on the gain.
That's
How
awesome.
perfect is that?
It's perfect. Yes. It's a very good strategy for the people who are in higher tax bracket. Few of my clients are, and then they're looking into beyond standard deduction, and I guess they can afford it, and they should perfectly do this. Yeah, because they going into 30, like you mentioned, you go beyond the standard deduction of 27,700. We are talking about married filing jointly, and it gives them a bigger tax bracket for the itemized deductions.
Right.
Yeah.
And plus, when it goes into the donor advised fund, honestly, you have the opportunity, too, to put it into various mutual funds. And over the course of the 2 years, or if you get into a routine of doing this, it can actually grow to a very nice charitable fund that you can keep using as a legacy,
Right.
even when you pass.
Right. Nice. Very nice. So we are reaching the end. So before we go, I want to touch base upon, the new thing that's been happening as of January 1st of 2024, the Corporate Transparency Act, where you're doing the beneficial ownership information report. Everybody's panicking. Well, I just want to say that you can file it yourself, or let the CPA help you file it, or anybody else you trust, an attorney or somebody. But you can go to www.FINCEN.gov/BOI. You don't have to have an account to go ahead and file it. And all you need is basically the LLC, the corporation, the S Corp entity formation documents, where you can have the EIN number and everything, and the address and the name of the entity and all the partners and the members, along with a good ID that is a valid ID. It could be a passport or a state ID or a driver's license. And you should be able to file this form. It is due for the entities which were formed on 01/01/2024. It has to be filed within 90 days. And the ones which are prior to that, which were formed before 01/01/2024, you have a year up until the January 1st of 2024. So we are filing it for the people, for the entities that we are forming now as of January 1st, 2024. And the rest of our clients, we're going to tackle that after tax season, as we should say, after April 15th, because right now, we are in deep into the tax season.
That's right.
I would say.
So I have a question on that. You mentioned the ID, because I have not delved into doing any of the reporting yet.
Okay.
Do we upload those to the website? Okay.
Yes. It'll give you an option to upload the ID. It asks for a date of birth.
Okay.
And a valid ID. Could be a driver's license. And for the foreign partners, it could be a passport.
Okay.
And I think that should be it. We should end our session. All right. Thank you so much.
Thank you.
Thank you so much for coming, Rebel.
Yes.
It was a pleasure. And thank you, everyone, for watching me again with Tax Bites with Poonam. I'll be back with the next episode next month. Thank you so much.